Mike, great to have you on the phone this morning. Let's start right there with financials because we've had a pretty strong run. Obviously, we have a Fed that has pivoted in monetary policy to a much tighter stance come 2022. Does the run continue?
Yeah, we think very much long-term at Oakmark, and given that approach, we've always valued our financials holdings on more of a normalized or a mid-cycle basis. And embedded within that normalization is the assumption that nominal rates will be higher than the ultra-low rates that we see today. So, we wouldn't expect much of a change in terms of our estimates of business value as a result of yesterday's update. But we certainly would expect a rising rate environment to be a net positive for the profit margins and the growth rates of our banks. But, even without a material rate lift, we think the financials we own are inexpensive today.
So let's talk some of those specific names you do own. What do you like here and why?
Wells Fargo is a name that we like today in financials. There's some company-specific factors that are really unrelated to interest rates that will also be important, drivers of future business value, such as a reduction in their highly bloated cost structure to a more normalized or peer average level. But when you look at Wells Fargo, the stock trades around $49 a share today. We think normalized earnings could ultimately exceed $5 a share. So you're paying slightly more than 9 times normal EPS for one of the best and most scaled banking franchises in America. Direct peers trade for healthy premiums to that, despite our view that their returns on on tangible common equity should be about equivalent.
Yeah, Fiserv is a name that comes up a lot in conversation too.
It is. It's Fiserv is one of the largest software and payment solutions providers to merchants and financial institutions. About 40% of the company's revenue comes from its merchant acquiring segment, but seemingly 100% of the market's focus is fixated on that division, given some fears about competitive encroachment from some faster growing and newer payments companies. Now, with Fiserv, you wouldn't know it from the stock chart, but its merchant acceptance business has actually continued to perform quite well in the face of this heightened competition, and its organic growth rate has actually accelerated relative to historical levels. We expect the business to generate over $7 of earnings in a couple of years, and the stock trades slightly north of $100 a share today. So given our medium-term expectations of mid to high single-digit revenue growth and continued margin expansion, we just think the company is much healthier than its multiple would suggest. And we think assets like Clover, which is their merchant acquiring solution for small and medium-sized businesses, is just not receiving the same credit as standalone peers.